We will look into how to estimate depreciation and salvage value in this video. Depreciation is simply defined as the reduction in the value of an asset with the passage of time due to wear and tear. So it is applicable to house or any product that you buy. For example, in the car, in the case of a car, if you buy the new car, it will have a value of, let's say, $60,000 or something. And every year, if you want to sell it back to someone else, it's going to reduce. Maybe at the end of 10 years or something, the value of the car will become around $10,000 or something. So this reduction in value of the car or the product every year, that is called the depreciation. And we will define some terms. And the first term is the salvage value. Sometimes it is called as residual value. It is referred to the worth of the asset at the conclusion of its useful life. For example, if the product is designed to perform for 10 years, after 10 years it is considered to be salvaged. So that value associated with the product after the life, in this case if it is 10 years, that is called the salvage value, or it is called as residual value. For example, if you buy an asset which is $100,000, and at the end of the 10th year, or maybe after 20 years, if it is estimated as $1,000, so if you try to sell that product which is like a scrap after the life, if it is sold for $1,000, then the depreciable amount would be $99,000. And how do we estimate it? Let's say we have two different methods. One is the straight line method, and the other one is the double decline method. So first we will take a look into the straight line method. The straight line method, the depreciation amount for each year is estimated using this formula, where we will subtract the residual from the initial price and you divide that by the useful life. For example, if the product is designed for running for 10 years and the initial price is $100,000, then the salvage value, if it is estimated as $1,000 after 10 years, then the depreciation amount per year is $100,000 minus 1,000 divided by 10. So that will be $9,900. So this will be the amount that we will deduct from the value of the product every year. And the estimation of this is really important because every year you have to account for this money from the expenditure. So this will become like an expense in the report. So the company can claim $9,900 each year as the depreciation expense during the 10 years course. So for balance sheet purposes, for tax paying purposes, this calculation is necessary. And how do we compare double declining method and the straight line methods? Double declining rate is typically 2 times that of the straight line rate. In this case it is around 10%, and in the case of double declining rate, that will become 20%. How the asset value will change over the period of time is shown graphically here. For example, straight line method, it will decline as like a straight line. In the case of double decline method, it will take another curvature. There is a meaning for this. The reason why sometimes we go for double decline method is you have a higher depreciation in the initial years itself, so that you can recover the cost of the salvage, the component in the earlier years. So you don't need to wait until 10 years to recover the money associated with the salvage of this equipment. And this can be made more sense using this calculation. For example, if you have a product which is having $100,000 value in the beginning at the year 1, if you use like 2 different methods, straight line method and double decline method. In the case of straight line method, after every year, $10,000 is deducted from the book value. So at the end of the first year, the remaining book value will become $90,000. That will be carried forward for the year 2, and then again that is deducted by $10,000 towards the end. So at the end of the year 2, it will be $80,000. So this will carry on until the year 10. So at the end of the 10th year, the value of the item will become 0. So that's how the straight line method works. in the case of double decline, it will use the rate. For example, if we used 10% here we will use 20%, which is double the rate. So the beginning book value is $100,000, and the depreciation amount in this case is $20,000, which is 20% of 100,000, and that should be deducted from the initial book value. So the remaining book value at the end of the first year will become $80,000. So this will be the beginning book value in the year 2. Again, 20% of this is $16,000. So the remaining book value will be $64,000 at the end of the second year. So this pattern will continue until the year 10, wherein which the final value will become equal to $10,000 or something. So if you look into the depreciation amount for both cases, for the straight line method and for the double decline method, here in the case of straight line method, it is constant $10,000. So at the same time, for the double decline method, it was high in the beginning 5 years or so, and it became lesser and lesser during the later phase of the time. The advantage of going for this method, for the double decline method, is let's say you are allocating a amount for to cover the depreciation cost from your expense, so that you can sell the product and get that amount covered. In the case of straight line method, after 5 years or 6 years, the machinery will perform poorer. Towards the end of the 10th year, it will become almost obsolete to use. So that's when you are actually using more money to cover the expenditure, but there is not much productivity coming out from that machine. So if you use the double decline method, you can use the machine at its prime time to make more money and to cover the depreciation cost. At the same time, when the machine wears down, you are going to expect less and less outcome from that. So that's the reason why we use these two different methods. And these are the two different methods mostly used for estimating the depreciation.